Welcome everyone to this first expert webinar called Private Capital Mobilization for Investable Projects. This is an event that is done by NATUREFIN, and this is part of of course, overall project that is co-funded by the European Union under Interreg Europe. And we are very proud to have this series of webinars since 2025. And today we have a great expert that has extensive experience in investing, of course, investments and also investable projects. This is why we want to introduce Matyas Horak. He's CFA FRM Senior Sustainable Investment Specialist. He has worked at many companies in London as well, in Europe, about credit, project finance, ESG, sustainability integration. He has more than 20 years of experience. Also, as well, ESG analytics, banking, corporate credit, restructuring, and risk management. So he has worked, he has extensive experience, so he knows what he's going to talk about. So we believe these expert webinar series are very relevant because we go from theory to practice, because we know that, of course, theories and ideas are nice to have, but we really need the expertise to implement this in policy implementation, of course, that you are doing, partners especially are doing in your own regions. So we had this topic today, and also tomorrow we will have day 2. So these are 2 days, so don't miss also tomorrow. Today we will focus on how local governments can mobilize more capital for nature. Also, why this is difficult in practice. You might already notice some difficulties in your day-to-day, in your routine, and we will go deeper into that, and also how projects can become more investable. How can you improve this? And also what investors are looking for. So we will do this in these 2 days. Today, we will focus on some aspects, and we will have a break at 11 a.m. approximately. We will tell you when the break ends and when it starts, and also when it ends. And also we will have a short time of questions. You will see a Q&A section there in the chat of the Microsoft Teams. So please, if you have questions, write in the Q&A section, and at the end we will answer these questions from the speaker. So many thanks for your time. So now, Matyas, your time starts. You can start to present. Many thanks.
Thank you, Anthony. Thanks for the introduction, and hope you can see my slides that I'm sharing, and the warm welcome from me as well, of course. So, as Anthony mentioned, so today and tomorrow I will look to continue what the previous 2 webinars have started and provide the participants a clear understanding of the challenges and potential solutions for local municipalities, local governments to mobilize private capital for nature projects. Some concepts were already explained in more detail on the EU taxonomy, for example, and on blended finance before, but can also reappear during this webinar from a slightly different angle. To kick off, the present challenge across Europe, municipalities and regions face intensifying climate and biodiversity and citizen expectations, while public budgets and EU co-financing remain constrained, widening the gap between the needs and available funding. And this webinar will examine how local governments can strategically mobilize private capital to help close that gap without displacing public finance or creating a marketplace for nature, by making projects sufficiently attractive and secure for companies, investors, landowners, and financial institutions to invest alongside them. So I will look at topics such as why private finance has not yet entered nature-based projects at scale, and address the underlying barriers in a hopefully transparent way. I will attempt to draw on concrete European and international case studies and try to demonstrate how appropriate preparation, enabling policy frameworks, and robust financial structuring can channel private capital into your parks, rivers, coastal areas, green urban infrastructure, with local authorities acting as pivotal enablers rather than passive recipients. So over the 2 sessions, participants would hopefully gain a clearer conceptual framework for how this works in practice, what investors require, what constitutes a bankable project, and how to adapt project design using instruments already available to municipalities and regions. So the content is tailored for non-specialists in both finance and biodiversity. So obviously you don't have to be an expert. So I will try to explain concepts at a very high level, explained from first principles and hopefully grounded in some real examples so that you can leave with some practical entry points and concrete ideas. So let's start. Before we go into tools and instruments and project design, I want to make sure that we are all working from the same basic vocabulary, because 2 of the words in the title of this webinar, capital and mobilizing, can mean very different things to different people, and we're not aligned. If you're not aligned on what we mean, it's easy to talk past each other. So starting with capital, in this context, capital simply means money that is available to fund your nature and climate projects, but it is useful to think of it in 3 layers. The first layer would be your own municipal or regional budget. This is the money you raise through local taxes, fees, transfers from national government. It is the money you control most directly, but it is also the most constrained. Many municipalities in Europe would already be allocating a significant share of their budgets to basic services such as roads, schools, waste, social care, and there is limited room to dramatically increase nature investment from this source alone. The second layer would be EU and national funding. These would be the structural fund, the cohesion fund, or national green investment programs. This is a crucial layer for most of the partners in this program, and we'll come back to it, of course, but it's also very competitive, time limited, and comes with sort of rules and co-financing requirements that limit how far it can go. And the third layer would be, which is this webinar is also principally about, is private capital. This means money from companies, from institutional investors like pension funds and insurance companies, from commercial banks, impact investors, landowners, developers, utilities, or infrastructure operators. As you can see, this layer is very large. There's a very significant amount of private capital in Europe that is actively looking for investment opportunities in sustainable infrastructure or green assets. The question is, of course, not where the private capital exists. The question is why it is not flowing into nature projects at the scale that is needed, and what local governments can do to change that. Now, in terms of mobilizing capital means more than just finding funding. It means actively using the levers you have as a public authority, your planning powers, your procurement decisions, or your regulatory choices, or even your ability to provide guarantees or subsidies to make it financially worthwhile and safe enough for private actors to put their money into nature projects alongside you. It is about changing the conditions so that investment, which would not have happened otherwise, does happen. So here the word otherwise is quite important because mobilization also means additionality. It means private money coming in because of something you did and not despite what you did. So now just quickly looking at the scale of the challenge, for example, on the left of this slide, quickly illustrated the biodiversity finance gap, which is one of the defining investment challenge of the decade, where private capital is only just waking up to its role. So according to an EU assessment, there is a financing gap at around 20 billion euros annually. The Commission's 2025 Environmental Implementation Review estimated the annual investment gap in biodiversity and ecosystem at around 40 billion euros. But I've seen 65 billion euros, I think, within the EU Nature Credits Roadmap. Unlocking the necessary funding for fully implementing the EU biodiversity strategy will require increased contributions from public budgets and private actors at national and EU level. And critically, a large share of this investment needs to happen at subnational level, in municipal watersheds, urban green infrastructure, and in regional forests and wetlands. Current public spending on nature in the EU covers only a fraction of this need, and the EU's own multi-annual financial framework allocates significant funds to biodiversity and nature, but these funds are not designed to and cannot close the gap alone. So national governments face their own fiscal constraints, and municipalities are the sharp end of these constraints, of course. So this means that the gap is somewhat structural. It is not a temporary problem that will be solved by a single new EU funding program. It requires a fundamental change in how nature projects are financed, moving from a model that relies almost entirely on grants and public budgets to a model that systematically uses public resources to leverage, de-risk, and attract private investment. That shift is already happening in some places. It happened in renewable energy, where a decade ago, wind and solar needed heavy public subsidy, and today they do attract significant private investment. And hopefully it's beginning to happen in nature. So why is it hard to mobilize capital for nature? We get to the heart of the challenge. We have established that there is a large gap between what needs to be invested in nature and what public budgets can provide. We have defined what mobilizing private capital means. So the obvious next question is, if there is so much private capital out there looking for good investments, why is it not already flowing into nature projects? So from my point of view, the answer has 4 parts, and each one has direct implications for what local governments need to do. So the first is what economists call the public good problem. Public good, of course, is something that benefits everyone, that cannot be easily excluded from, and when one person using it does not reduce its availability to others. Clean air is a public good, for example. A healthy river ecosystem is a public good. Urban biodiversity is a public good. The problem with public goods from an investor's perspective is that they are very hard to monetize. If your investment improves air quality or river health for an entire city, how do you charge the people who benefit? Of course, they cannot be excluded from enjoying those benefits, so they have no reason to pay for them. This means that the financial return on many nature investments is close to zero, even if the social and environmental return is very high, because the externalities are not valued or internalized in another way properly. So investors, by definition, need financial return. The second reason is about nature. It is about the nature of the returns, even when they do exist. Nature projects typically take a long time to deliver benefits. So restoring a wetland, regrowing a forest, or rebuilding soil health, these could be 10, 20, or even 30-year processes or beyond that. Most private investors have shorter time horizons, or at least a lot of them, and the returns, when they do come, are often uncertain. They depend on the weather, ecology, policy, market conditions in ways that are hard to model in a spreadsheet. Investors price uncertainty as risk, and high risk means they demand either higher returns, which nature projects often cannot deliver, or they stay away altogether. And the third reason is the structural one. The nature project pipeline is simply not investor ready at scale. Most nature projects can be, in Europe, for example, small, a single wetland restoration or a city park upgrade or a riparian buffer. These are too small to justify the due diligence cost sometimes of a typical institutional investor, whose minimum ticket size could be upwards of 10 or 20 million euros. The projects are also often technically complex, involving ecological outcomes that investors do not know how to evaluate, and governance structures that they are unfamiliar with. So even impact-oriented investors who want to invest in nature could struggle to find projects that are ready for investment. The fourth reason is about the policy environment in sectors where private investment has successfully scaled. In renewable energy, social housing, it was almost always enabled by clear, stable policy frameworks that created predictable revenue streams. So, for example, feed-in tariffs for solar, housing benefit contracts for affordable homes, or long-term concession agreements for roads and water. So for nature, these frameworks are largely missing or have been largely missing. There is no equivalent of a feed-in tariff in biodiversity yet, or standard contract for a nature-based flood protection service. There's no stable and liquid market for most ecosystem services in many places and EU countries. So this is important because none of these four barriers is a law of nature. There are problems that can be addressed. And in each case, the actions of local and regional governments are, of course, key to addressing them. You cannot fix investor time horizons or single-handedly create national policy frameworks, but you could reduce the risk profile of a specific project or create local revenue mechanisms to aggregate small projects into larger ones and to use your planning and regulatory powers to create the policy certainty that investors need. And this is the underlying logic of what we will discuss for the rest of this webinar. Now, I will dive a little bit deeper to each of these four barriers to unfold some of the details. Starting with the most fundamental one, the public good problem. So nature delivers what economists and ecologists call ecosystem services. They are tangible benefits that healthy natural systems provide to people and communities. A floodplain, a wetland, for example, absorbs rainwater and prevents flooding downstream, or a forest filters water and replenishes the aquifers, or urban trees reduce the temperatures in summer heat waves. Coastal marshes protect shorelines from storm surges. So these are real, potentially measurable, high-value services, but there's a challenge. Most of these services are not currently priced or paid for. Almost nobody would send a bill to, let's say, a city saying you owe us for the flood protection provided by XYZ floodplains this year, or charges a water utility for the filtration services provided by a forest. These services exist and are valuable, but there is no transaction, no contract, no payment. This is the essence of this problem. For an investor, this is a critical problem because the investor needs to know where will the money come from to service my investment? What is the revenue stream? If the benefits of a project flow freely to everyone and nobody pays for them, there is no revenue stream and therefore there is no investment case. Now, important to note that this is not an immovable law. Societies have found ways to pay for public goods before through taxes, through charges, through regulations that force beneficiaries to pay. The EU Water Framework Directive, for example, already contains a principle that water services should recover their costs, including environmental costs. Some countries have created payment for ecosystem services schemes that create revenue flows from beneficiaries to land managers who maintain ecosystems. These are partial, maybe imperfect solutions, but they do show that the public good problem can be partially solved through policy design. And this is where local governments could come in. You have the power to create local revenue mechanisms, a green infrastructure levy on developers, or a tariff element in water bills that funds a catchment restoration, or a concession agreement that requires a company using a natural resource to pay for its maintenance. So these are real instruments that real municipalities have used, and we'll come back to them in detail. For now, the key takeaway is that the public good problem is real, but it is not inevitable. It is more of a policy design challenge, and local governments are among the most important actors addressing it. The second barrier is about risk and time, and this one is deeply woven into how financial markets work. So it is worth spending a moment to explain it clearly. When an investor puts money into a project, they are making a decision under uncertainty, and they do not know exactly what returns they will get or when. What they do try to do is estimate the likelihood of different outcomes and price that uncertainty into the expected return they do require, and price that uncertainty, sorry. But this is called risk-adjusted return. And the riskier an investment appears, the higher the return the investor demands to compensate for that risk, of course. A nature project presents a particular combination of risk factors. that most investors find very challenging to price. First, there is ecological and environmental uncertainty. Will the wetland actually restore itself on the expected timeline? Will the species respond as the ecologist modeled, or will a drought or a flood or invasive species set back the restoration by 10 years? These are genuinely uncertain questions, and investors do not have the tools or expertise, in many cases, to model ecological risk in the way they model, say, construction risk of a building or interest rate risk. And the second is temporal uncertainty. Many nature projects take, as I mentioned, 10, 20, or even 30 years to fully deliver their ecological and financial benefits. Many institutional investors, pension funds, insurance companies think in terms of 3, 10, or maybe 10-year investment cycles, with some exceptions for more sort of infrastructure-oriented or for their illiquid assets. We can talk about this a little bit more later. Even where they can hold longer, they need to be able to value their investment at any point in time, and projects whose main value will be delivered in 25 years. Of course, it's quite difficult to value today. There is policy and regulatory uncertainty. A nature project that depends on a particular policy framework, for example, a carbon price or an ecosystem service payment scheme, is exposed to the risk that the policy changes, or that it is cancelled, or it is not extended. In Europe, these frameworks are still being built, and investors are understandably cautious about committing capital to projects that depend on policy stability over decades. So fourth, there is market uncertainty for nature-related revenue streams that depend on markets, for example, voluntary carbon markets. The markets themselves are nascent, or are illiquid, or volatile and opaque. There is no clear standard mechanism for pricing, for example. This does add another layer of risk on top of the aforementioned one, so ecological and policy risk. The combination of these 4 types of uncertainty makes nature projects look to a mainstream investor like a very high risk asset class. And high risk means high required return, which nature projects with their diffuse, long-term, uncertain benefits typically cannot deliver. So the key implication for local governments is that reducing risk is just as important as creating revenue. Even if you have a revenue mechanism in place, if investors still perceive the project as too risky, they will not invest or will demand returns that make the project unviable. De-risking tools that we'll talk about, especially tomorrow in tomorrow's session, so guarantees or first loss capital or concessional loans, are therefore central to the toolkit. And as I mentioned, we will talk about them later. So barrier 3 is what practitioners call the pipeline problem. In some ways, the most practically actionable one maybe for local governments. So if you imagine that you are, let's say, a fund manager for a large European pension fund, and you have been tasked with looking into building a portfolio of nature and biodiversity investment. Your colleagues, let's say in the impact or sustainable investing team, they have done some research, and maybe there is some appetite to deploy the capital, notwithstanding to what the projects look like. So what happens next? You would start to look for projects, and what you find is that overwhelmingly the projects that exist are either too small, too early stage, or maybe poorly documented, or structurally not appropriate for your fund to invest in, not fitting your existing requirements, let's say, for integrating them into your overall sort of portfolio of assets. So a wetland restoration project in a small municipality might cost a few million euros. Your fund's minimum ticket size, let's say, is 15 million euros. And because the due diligence cost alone, the legal review, the financial modeling, the ecological assessment would be close to hundreds of thousands of euros for a project. This would make small investments uneconomic. You need to aggregate multiple projects or find a platform that has already bundled these projects or these type of projects. And these structures, they often do not exist. So even when you find the larger projects, it is not necessarily investment ready because maybe there is no bankable business plan. There is no clear revenue model that has been stress tested. There is no legal structure through which the investment can be made, no legal entity, no concession agreement, no bond structure. The project does exist as a planning concept and not as a financial instrument. Then there is also a resource gap or skills gap. Nature projects are designed by ecologists, planners, and conservation specialists, and financial structuring requires a different set of skills, cash flow modeling, legal structures, risk allocation, investor relations. These two communities rarely sort of work together or sit at the same table, let's say, at the start of project design, which means that by the time someone tries to raise private finance for a project, its fundamental structure is often incompatible with maybe with how investors operate. This is an area where local governments can have an enormous impact, maybe even without larger budgets, because the key actions are investing in project preparation and investment readiness, using maybe grants or technical assistance to develop projects to the point where they can be presented to investors, aggregating small projects into larger platforms that can attract institutional capital, and building the internal and contracted capacity to bridge the ecology finance skills gap. So we'll come back to specific instruments for doing this. That the main message for now is that pipeline problem is real, but it is largely a capacity and preparation problem, and hopefully not an irreducible structure one. It is therefore one of the barriers where targeted public investment in project preparation or capacity building has the clearest and maybe most direct impact on the volume of private capital that flows into nature. The fourth and final barrier, from my point of view, is the absence of the policy frameworks that would allow private capital to flow into nature at scale. So maybe this is the most systemic one. So to illustrate this, again, bring up the renewable energy comparison. It's quite an instructive one. Decades ago, wind and solar energy faced almost exactly the same challenges that nature finance faces today. The technology did exist, the environmental case was compelling, there were willing investors, but the economics did not really work in many cases because the cost of generating renewable electricity was higher than the market price with existing traditional technologies, and there was no mechanism to bridge that gap. What changed? Everything was policy. Governments across Europe introduced feed-in tariffs, which are these guaranteed long-term prices for every unit of renewable electricity fed into the grid. These tariffs created a predictable government-backed revenue stream for renewable energy projects. And because the revenue was predictable and backed by the state, investors could model it with confidence, banks could lend against it, and project developers could build at scale. The result was a dramatic fall in the cost of renewable energy and an explosion of private investment. Of course, the technologies themselves have evolved a lot as well, but that was also indirectly helped by these policies. So for nature, we don't really yet have the equivalent of a feed-in tariff. There is largely missing standard mechanisms that, for example, guarantees a payment of every hectare of wetland restored, or every ton of carbon stored in a forest, or every unit of biodiversity enhanced, notwithstanding that they started appearing, and we'll talk about some examples in the later stages of this webinar. There are some partial mechanisms, like voluntary carbon markets, and some national agri-environmental payment schemes, and the EU Nature Restoration Regulation, which I'll have a slide on tomorrow as well. But they can be fragmented, inconsistent, and do not yet provide the kind of long-term bankable revenue certainty that a lot of investors need. So this is a national and EU level challenge, and we could be honest about the fact that no single municipality can solve this alone. But local governments are, of course, not powerless here either, because at the local level, you can create your own policy frameworks if you have the authority. For example, local biodiversity requirements for developers, for green infrastructure obligations, in planning permissions, long-term service agreements for nature-based solutions that provide the contractual certainty investors need. You can also advocate collectively for the national and EU policy changes that you think need to happen. So the one important nuance here that I wanted to mention here is that the policy uncertainty is itself a financial risk, and an investor considering a 20-year commitment to a nature project would ask what happens if the policy of this project depends on changes, let's say in 5 years. And if the answer is uncertain, they will either not invest or demand a higher return to compensate. So creating a stable long-term policy commitments through local plans, multi-year budgets, or statutory obligations is itself a powerful de-risking tool. Now to summarize what I've covered in this module, nature projects face 4 structural barriers for private investments: the public good problem, risk and time horizons, the pipeline gap, and missing policy frameworks. None of these are insurmountable, of course, and each one has partial solutions that local governments can contribute to. So now we get into the question of investability. How can nature projects be more investable? Before we go further into that, I just wanted to spend a moment making sure that we all share a common understanding of what we mean by nature-based solutions, because the term is used very loosely sometimes in policy circles, and distinctions matter enormously when it comes to attracting private capital. So the summary of definitions that's used by the EU and international bodies is that nature-based solutions are actions that would work with or mimic natural processes to address societal challenges, things like flood risk, heat stress, water quality, while simultaneously delivering biodiversity benefits. This dual purpose is important because nature-based solutions are not purely conservation measures. They deliver services to people, and it is precisely those services that create the potential for revenue. Now, nature-based solutions come in different forms depending on the ecosystem context. So I've here grouped them into 4 main categories, but there are other category schemes that do exist. So first, urban nature-based solutions. These are the types most familiar to city managers: green roofs, urban forests, rain garden, parks, and tree-lined streets, for example. The primary purpose is to manage heat islands or reduce the surface flooding or improve air quality and support resident well-being. For urban partner municipalities of the project, the NATUREFIN project is often the entry point into nature finance. The challenge here is, of course, that the benefits of cooler streets and, let's say, better mental health are, even though they're real, but they're very diffuse. They can be diffuse smaller interventions or sizes. which might be making monetization harder without the right instruments. Second, freshwater nature-based solutions, so things like restoring the floodplains or creating a riparian buffer strips along a river, or constructing wetlands to filter runoff. These directly address flood risk management and water quality, which means they often deliver measurable savings to water utilities, insurers, or local governments. This category could have therefore strong potential for a beneficiary pay revenue model, where the downstream beneficiary, a water company, for example, pays for upstream restoration. The third category is coastal and marine nature-based solutions. So salt marsh, seagrass, mangrove restorations. These protect coastlines from erosion and storm surge. And they also store significant quantities of carbon, which is why they normally attract interest from the carbon credit markets. For partners that are located on or near the coast, this category could maybe deserve particular attention. And fourth, terrestrial and landscape nature-based solutions, so forest restoration, peatland rebatting, agri-environment schemes. These operate at landscape scale and often involve working with farmers and land managers. They can generate carbon credits, biodiversity units, and water quality improvements, maybe simultaneously, even making them potentially attractive for the blended revenue models. I think revenue stacking was a concept that was mentioned in the second webinar, so hopefully you are familiar with it. The critical point would be is that each category has a different cost structure, a different timeline to maturity, a different set of potential revenue streams, and a different type of investor maybe or financier who's most likely to engage. A green roof project requires very different financial structuring potentially from like a peatland rebatting scheme. And so the understanding your nature-based solution type is maybe the first step of to identifying your finance pathway. So before talking about investability and bankability, I'll look at a little bit just the mirror image, the common patterns in projects that fail to attract private capital or that do attract it, but then disappoint. So I think I created 6 categories here. The first and most common failure pattern is the absence of a revenue model. The project was designed as an environmental or ecological intervention funded by grants, with no plan for how it would be financed once the grant ran out. This could be a prevalent problem in European nature projects. The ecological design might be excellent and the environmental case is again compelling, but the financial case simply does not exist. The second failure is unrealistic assumptions, maybe overestimated revenues. The project might have a revenue model on paper, but the assumptions can be unrealistic. For example, carbon prices are assumed to be higher and more stable than what the market would support at the end of the day, or biodiversity credit demand is assumed without a firm buyer in hand. Service contract payments could also be assumed without a signed contract. When these optimistic assumptions do meet reality, then the project can become unviable. The third failure pattern is weak governance. Even when a project has a viable revenue model, investors would not commit if they cannot trust the governance. Maybe there is no legal entity, management responsibility spread informally, or there is no independent monitoring, or there is no audit trail, or there is no documented long-term commitment. And so for what governance weakness can also be a common reason that deals that get close to completion fall apart at the due diligence stage. The fourth failure pattern is policy reversal or uncertainty, project that is designed around a specific policy framework. Let's say an agri-environment scheme or a feed-in tariff for energy crops or a national ecosystem service payment program. And then that framework is changed, cancelled, or is not renewed. The revenue basis then would evaporate. This is why policy stability and long-term public commitment are very important. Fifth, could be investor mismatch. Let's say the project team approaches the wrong type of investor to pitch the idea, a commercial real estate fund for a wetland restoration project, or let's say a fund that mainly invests in equity with a bond structure, or for concession-like capital approach for a private equity fund, or a grant-oriented foundation for a commercial equity investment again. So the fundamental terms could not match then the deal, of course, cannot close. The sixth failure pattern is the skills gap that I alluded to before, project developed by ecologists and planners without finance expertise. This would not get translated into the legal, financial, and contractual structures that investors require. The projects exist as a concept, but never really becomes an instrument. And bridging the skills gap through capacity building and specialist advisors could be very important investments any municipality can make. So now we have spent some time on barriers and types of common failure patterns. We can shift the perspective and start talking about solutions. The first concept we need to understand is bankability. So bankability is a word used by finance professionals to describe whether a project can attract private investment, specifically whether a bank, an investor, or a fund would be willing to put money into it. A bankable project is one where the investor can see a credible path to getting the money back with a return that compensates them for the risk they are taking. It is essential to understand that a bankable does not mean the same as good. A project can have enormous social and environmental value and still not be bankable if it lacks a revenue model or a legal structure that allows investment. Conversely, a project can be bankable, of course, in a narrow financial sense, while delivering questionable social value, which probably see cases of from time to time, or questionable environmental value, sorry. So bankability is a financial concept, not a moral or an ethical concept. What could make a nature project bankable? I pulled out 4 core ingredients here. The first is a credible revenue stream and a solid financial model with stable and predictable cash flows. This is the money that will come in over the project's lifetime, and that will be used to pay back the investors and generate a return. The revenue can come from many sources. It can come from service fees. It can come from government contracts, or maybe carbon credits, land value appreciation, or cost savings for infrastructure operators, insurance premium reductions, and more. So the revenue does not necessarily have to be large, but it has to be predictable, documented, and contractually secured if it can be bundled together with other revenue streams. It should be based on verifiable data and realistic market assumptions, such as energy prices or occupancy rates or pricing strategies, and preferably should include sensitivity or scenario analysis for a base case or an upside or a downside scenario. The second is manageable risk profile. All investments carry risk. The question is whether those risks are identified, quantified, and allocated to the parties that are best placed to manage them. A bankable project has a risk analysis that would identify the main risks, construction risk, environmental risk, revenue or market risk or policy risk, and the structure that assigns each risk to the party or to the stakeholder that is best placed to bear that risk. Let's say public actors might be better placed to bear policy risk, or private operators might better be placed to bear operational risk. The third is a competent and credible sponsor. Investors are not just investing in a project, they are investing also in the people who would manage that project. So a bankable project normally would have a sponsor, either a municipality or a development company, or an NGO with a great track record, or a special purpose vehicle that is a company that has a company or investor behind it, with preferably a good track record. So this sponsor would have the technical capacity, the governance structure to deliver. The fourth is explicitly the clear legal structure. So we mentioned that weak governance is one of the most common reasons why investors could walk away from otherwise promising projects. Money needs to flow through legal entities under contracts that specify rights and obligations. And a bankable project would have a legal vehicle, a company, a fund, or concession agreement, a bond issuance that is appropriate for the type of investment and the jurisdiction. So there are formal allocation of roles and responsibilities and liabilities. There should be enforceable agreements. It could use entities that have a ring-fenced revenue stream and collaterals related to the project. So that's what I mentioned, special purpose vehicle before. So that would be it, to isolate and protect the project finances and ensure auditability. So there are other important ones, such as contingency planning, for example, mechanisms to address underperformance, delays, or cost overruns would be handled by reserve accounts or a step-in right of an investor. These would be important to maintain operational resilience. Of course, the good news is that none of these four ingredients are impossible to create. They do require work, expertise, and maybe often some upfront public funding for project preparation, but they could be achievable. So now that we understand what bankability means in practice, I wanted to have a look at a few main types of revenue models that can make a nature project bankable in practice. These are not mutually exclusive. Many successful projects combine the elements of two or more, but thinking in these categories could help clarify what kind of revenue architecture a project does need. So the first type is regulatory compliance. In this model, a developer, utility, an industrial operator, has a legal obligation to deliver a nature outcome or compensate for environmental damage. They can either deliver the outcome themselves or maybe pay someone else to deliver it on their behalf. The payment from the obligated party to the nature project is the revenue stream. So let's say biodiversity credits that is introduced in England and being discussed in various EU contexts and countries. I have an example slide on it for tomorrow's session. Can be a good example because here developers must demonstrate a net gain in biodiversity compared to pre-development levels. And if they cannot achieve this on site, they must fund off-site compensation. This creates a demand for nature restoration projects and a willingness to pay that is driven by legal obligation rather than altruism. The second type is the beneficiary pays model. Here, the people or organizations who benefit directly from ecosystem services are identified and charged for them. The most developed example in Europe probably is water utility funding for catchment restoration. Water utilities, for example, need clean water. Treating polluted water at the treatment plant is expensive, and restoring the upstream catchment reduces the treatment costs. So some water utilities have begun funding catchment restoration as a cheaper alternative to, let's say, water treatment infrastructure. The utility is the beneficiary of the ecosystem service and pays for its delivery. So this could often be a genuinely bankable revenue model. The third type is savings and efficiency. Nature-based solutions often deliver the same service as conventional gray infrastructure in flood protection, dams, for example, or cooling or water management at a lower cost or over the project lifetime. If a municipality can quantify the cost savings from choosing a nature-based flood solution over a concrete flood wall, those savings can be monetized and used to service private investment. So the logic here is similar to energy efficiency investment. You invest upfront, and then the savings pay back the investment over time. The fourth type is market-based revenue, selling credits or certificates that represent verified nature outcomes. Carbon credits from forestry or wetland restoration are the most developed example. Biodiversity credits and water quality credits are also emerging. These markets are real but still young, and their creditworthiness depends heavily on the robustness of the verification standards and the liquidity of the market. They can contribute to a project's revenue stack, but are generally not yet reliable enough as a sole revenue source. For local governments, the practical question, I guess, is that which of these four models is applicable to the types of nature project that you want to develop? And the answer would vary by project type and context. And we will explore some specific examples. So getting to those, I would just want to talk to a few examples for mechanisms available to EU municipalities, including two on payments for ecosystem services or PAS for short. The concept is simple. Nature provides services to people: clean water, flood protection, carbon storage, pollination, cooling. Somebody benefits from those services, and payments for ecosystem services is a mechanism to make the entity that benefits pay the entity that provides or protects the service. When that happens, the nature conservation stops being a cost and starts generating income. So the four models that may be are most directly relevant to the 6 partner municipalities of the NATUREFIN project, but might be relevant for anybody else on this call as well, of course. The first is watershed or water quality payments for ecosystem services. This is maybe the best established PAS model. The logic is that the land management upstream affects the downstream water quality. If a municipality or farmer upstream protects forests, wetlands, or agricultural buffer strips, the water utility downstream spends less on treatment. So the water utility pays the upstream land manager. The very early case, I think, in Europe was the Vittel case, and in France, where I think Nestlé paid farmers to change the practices to protect its mineral water source. Yeah, so this is a famous early example, but across the Netherlands, for example, water boards, I think, operate similar schemes. And for our partners with catchment assets, this model deserves serious attention. The second is biodiversity net gain. Again, this is rapidly growing in importance as these biodiversity net gain requirements spread across European planning systems. A developer who destroys a habitat at one site must show net gain, meaning they need to fund habitat creation or restoration elsewhere. Municipalities that own land and can provide verified biodiversity units are in an excellent position to sell those units to developers, if there is such a case. So England has moved furthest, I mentioned before, and there is a slide on that tomorrow, with mandatory biodiversity net gain under its planning law, but I believe that France and Germany have maybe voluntary or mandatory offsetting schemes that are expanding, and then there might be others. I might try to mention them tomorrow. The third, maybe a flood risk payments for ecosystem services scheme. So as climate change increases flood frequency, insurers and downstream local authorities are increasingly willing to pay for upstream natural flood management. So if restoring the floodplains or creating detention wetlands or riparian forests, these measures could reduce peak flood flows. And I think here the Bavaria floodplain restoration program can be a good example that I think is ongoing in Germany. The fourth could be carbon payments. So forest, peatlands, and wetlands do store carbon, and verified carbon credits from these ecosystems can be sold on voluntary or compliance markets. We will come back to specific EU framework on this even more tomorrow, but I think maybe the next slide, there is a bit of mention on it as well. The carbon removal certification framework, when we do talk about regulatory framework that is impacting municipalities. For, I think the key practical starting point for any partner municipality for NATUREFIN is that you can map your land assets, you can identify which ecosystem services they provide, and then you can ask who benefits and whether there is a mechanism to make those beneficiaries pay. You might be sitting on, let's say, payments for ecosystem services opportunity you have not recognized. So I think I could start to talk about the next slide, but I think this is the point where we might break for 10 minutes. And sorry, I didn't mention this at the start when I introduced the different sections of the webinar, but I think this may be a good time to break for 10 minutes and then continue, I think at 11:10 or 11:09 or so. Does that sound good? Yeah, okay.
Yes, sounds very good. So we will do a break. We will return at 11:09 in this case. So I will just write in chat as well. So many thanks. And then we will return back.
Okay, then I will just mute myself for 10 minutes.
Yeah, okay, many thanks. Okay, so it is 11:09. So please, Matyas, you can continue. So we are returning to the session. Many thanks.
Thank you. Yes, so before we would be jumping into the who are the investors and what are they looking for, I wanted to talk about a very important concept for nature finance. There is a phrase, of course, that experienced sustainable finance practitioners probably use repeatedly: you can only sell what you can measure. So this monitoring, reporting, and verification, or MRV, is a commonly used term, and this means the infrastructure that makes nature finance possible. Without it, there is nothing for an investor or buyer to purchase because there is no credible proof that nature outcomes were actually delivered. So to explain MRV, what it involves and why it potentially matters for your projects, MRV is the system of monitoring and measuring ecological outcomes over time and reporting those outcomes according to agreed standards, and having an independent third party verify that the reported numbers are accurate and credible. It is, in a sense, the audit system for nature outcomes, just as financial audits verify that accounts reflect reality. What specifically needs to be monitored depends entirely on the revenue model you're targeting. If you're selling carbon credits, you need to monitor carbon stocks and sequestration rates using standardized methods that produce figures in tons of CO2 equivalents, for example, that is short for different types of greenhouse gases expressed in CO2 terms. If you are participating in a biodiversity net gain scheme, you need habitat condition scores, let's say species richness indicators, and potentially connectivity metrics for species. If you're operating a water quality PES scheme, you need water quality measurements at defined monitoring points before and after the intervention. If your revenue model comes from flood risk services, you need evidence of peak flow reduction. So the good news is that the cost and the difficulty of MRV has been declining rapidly due to technological improvements. For example, satellite imagery can now track land cover change, vegetation density, and carbon stock proxies at very fine resolution and relatively low cost. Remote sensing can detect wetland extent and condition, for example, things called environmental DNA or eDNA that allows species detection from water samples without an extensive field work, potentially. There is something called AI-powered image analysis that is transforming species identification. So these tools are making it increasingly feasible for municipalities to establish credible monitoring systems without needing large teams of ecologists. However, there is, of course, one thing that technology cannot replace, which is a credible baseline. You cannot demonstrate that your project improved nature unless you have documented what the condition of nature was before the project started. So this is a very important practical action maybe for partner municipalities that you could take now, regardless of whether a specific project is ready to proceed. If you commission ecological environmental baseline surveys of your key land assets, you could document habitat condition or species presence, water quality, carbon stocks. This is the data foundation upon which potentially any future revenue mechanism will be built. Without it, you are starting a lot of project discussions from zero. I have mentioned some maybe key terms and standards that project promoters and developers across the globe have been using. Of course, there are the EU CRCF methodologies, and we can talk about those later. But things that are used, for example, for carbon projects that generate carbon removal units or carbon credits are Verra, gold standard, that are two leading voluntary carbon credit certification programs, distinguished they're primarily by their focus on scalability versus, let's say, co-benefits. I think Verra was established in 2007, a gold standard in 2003. Gold standard mandates contributions to at least 3 UN Sustainable Development Goals and requires rigorous stakeholder engagement. So they have slightly different criteria. Verra prioritizes scalable greenhouse gas emissions reductions. I also mentioned as an example the biodiversity metric 4.0, which is what is used in England. It's an updated version of the statutory tool to measure and calculate biodiversity net gain. So some of these examples and words, if somebody has the inclination to delve into a little bit more in detail to understand better, I think it can provide a good foundation on carbon credits and biodiversity credits and how these methodologies try to calculate nature-related metrics. So we'll jump into the investors section, and I think this is the last section for today's session. So far, we have been talking about investors as if they are one single category. Of course, in reality, this is not the case. The investor landscape is very diverse, and one of the most important strategic decisions that municipality can make is choosing who to target for which type of project at which stage of development of the project, or let's say a nature-based solution. Because approaching the wrong investor type or approaching any investor before the project is ready could be a common and maybe avoidable mistake in nature finance. So the 5 categories of capital providers that could be relevant for nature projects I created here. Of course, there are not sort of red lines between the different categories, and in some cases they can overlap, or some particular investors can wear different hats. Especially the large ones. Maybe some companies can have philanthropic arms. But anyway, these are the categories I create for now. So first, philanthropic capital. These are foundations and large environmental donors operate with little or no expectation of, let's say, financial return. They are willing to fund activities that are genuinely additional, that would not happen without their support. For early stage, high risk or unproven projects, let's say pilots, feasibility studies, baseline surveys, proof of concept work, philanthropic capital is often the best and sometimes the only available source. So key players in active in nature finance might include the likes of, let's say, the European Climate Foundation or the Lodes Foundation or Arcadia Fund. Our partner municipalities could be aware of their grant programs because it might help their work. Second, development finance institutions. I took multilateral and national development banks here as well, which occupy a unique sort of middle space. They do deploy public capital, but they do so as lenders and investors rather than grant givers. They require projects to be financially viable in many cases, but they might accept lower returns and higher risk than commercial capital. Now, I want to mention here that it is not necessarily the case. Some development finance institutions are sort of have a more commercial angle, and they might look for higher return for the same project as another development finance institution. So it's important to understand well their mandates. They also can have a strong preference for projects aligned with EU policy objectives. Of course, the EU development banks or European development banks more broadly, which is an advantage for nature projects, given the aforementioned nature restoration law and the EU biodiversity strategy. The third, impact investors. This is a fastly growing category. These would be private sector fund managers who explicitly combine financial return objectives with environmental and social impact objectives. They accept returns that might be slightly below pure commercial benchmarks in exchange for genuine ecological outcomes. So there are a growing number of EU-based nature funds that fall into this category. There could be, let's say, large institutional investors now trying to create an impact investing arms. Those arms might be more sort of commercially oriented in a way and might not want to pilot projects, but they might be willing to invest more in sustainable management practices, let's say, in agriculture and forestry. In any cases, and then there are other impact investors who are more sort of pioneering, and they might be willing to pilot projects or fund early stage sort of solutions. So they typically invest in projects that are a little bit more than pilots, as I mentioned, but not all of them. So they need projects with some revenue track record, maybe a credible MRV, as mentioned before, and maybe a clear path to scale, depending on which impact investor we are talking about, because this category in itself can be quite diverse. So fourth, let's say traditional institutional investors. These are pension funds, insurance companies, sovereign wealth funds. These are, let's say, the largest pools of capital on the planet. They can have long time horizons and in theory are well matched to nature projects, but in practice, as I alluded to before, they are very risk averse and can require maybe high liquid standardized investment instruments, or it can be illiquid assets, but again, tried and tested nature-based solutions. Few EU nature projects currently meet these criteria, but this should be the direction of travel. Let's say the development of nature bonds or listed nature funds or standardized credit instruments, partly designed to unlock institutional capital at scale. Then I have a category here called corporate buyers. These are not, let's say, traditional investors. I could call them quasi-investors. They are companies that need to purchase ecosystem outcomes, carbon credits or biodiversity credits or water quality improvements to meet their own reporting and target setting requirements on their, let's say, their net zero frameworks. For municipalities, corporate buyers are in some ways the most accessible counterparty because the relationship is a service transaction rather than a complex investment structure. The practical implication is that if you know which category matches your project stage and disciplined about not wasting time approaching investors who are structurally unable to engage, maybe you could develop nature projects and scale earlier. So getting into something called a capital stack, which is one of the most important and conceptual tools for understanding how nature projects could be financed. This is a term from finance that basically simply means how a project is financed layer by layer and then who bears what risk. You can think of it as a pyramid or a layered cake, maybe. At the very bottom are the most risk-tolerant sources of capital, let's say grants, public subsidies, philanthropic money. These providers do not expect to be repaid in full, maybe, or at all. Their purpose is to absorb the highest risk in the project, the risk that the project may not work, may not generate revenue, may take much longer than expected to become financially viable. In a nature project, this top layer is, this bottom layer is almost always includes public money. That could be EU structural funds, could be national climate budgets, or the municipality's own capital investment budget. Above that layer sits concessional debt or concessional loans. These are loans with special conditions, below market interest rates, longer repayment periods maybe, or grace periods where no repayments are required. So multilateral development banks and national development banks or development finance institutions like, let's say, KfW in Germany could offer this kind of finance. They exist precisely to bridge the gap between pure grants and a fully commercial investment. At the top of the capital stack sits the commercial capital. This could be bank loans, institutional investor equity, or green bonds. These providers want competitive market returns, and they also want a robust repayment security. And they would normally only enter if the layers below them have reduced the risk to a level they can accept. So blended finance, there was a section, I think, on blended finance on the first webinar, but I wanted to talk a little bit here, and also tomorrow I have a specific slide on it, is the deliberate strategy of combining these layers so that a cheaper, more patient and more risk-tolerant public capital crowds in the commercial capital that would not otherwise engage. The multiplication, or something that is also called the mobilization ratio, as in how many euros of private capital each euro of public capital unlocks, is a key performance indicator in development finance. And let's say typical ratios could range from 2:1, 3:1 to 7:1. And there is a lot of talk now in the, let's say, development finance circles on how to increase that mobilization ratio beyond 10 or even 15, and also setting maybe targets around that. So I think for partner municipalities, the key question is, what can you contribute to the bottom of the stack? Can you bring in partners who also can contribute to that layer? Maybe you do not need to fund the whole project. If you can contribute to land, or if you can contribute to long-term lease or a permit pathway, or a first loss guarantee, or even a procurement commitment that is potentially enough to unlock the layers above. So your job is not to be the investor, of course. Your job is to create the conditions under which investors want to invest. This is a fundamentally different and more achievable role. So we have discussed somewhat the capital stack, private investors and commercial capital, but for most of our partner municipalities, the most accessible and practical finance partners are not private equity funds or pension funds. They could be national development banks, or maybe the European Investment Bank. So I wanted to spend some time on who these institutions are and maybe how to engage with them. So national development banks are publicly owned or state-backed financial institutions that exist in virtually every EU member state, I believe. Their mandate is to provide financing for public interest activities that commercial banks cannot or will not fund at an adequate scale or on adequate terms. Even though they can have grant-like programs, they are primarily not grant givers, but they can offer loans and guarantees that are significantly more favorable, or could be more favorable than market rates, or to mobilize more private capital. So to give some specific examples for the partner countries and other municipalities who might have joined this call. So in Germany, KfW is the primary institution, and it operates specific programs for municipalities covering green infrastructure, nature protection, climate adaptation. And I hope I'm not wrong, but I do think that, or I've seen that the KfW's scope could be beyond that of Germany. So they do, I'm not just talking about emerging markets, but within Europe, they could be involved in different schemes beyond Germany, maybe for example in Eastern Europe or elsewhere. In France, there is BPI France that operates, let's say, biodiversity and green infrastructure financing windows. In Netherlands, there is the NWB bank, which specifically lends to water boards, municipalities. Poland has the BJK. This acts as an intermediary for EU cohesion funds, and also has urban development loan facilities. I think Spain's ICO has green investment lines, maybe, and then like the likes of the Hellenic Development Bank, for example, Greece, would have a similar role. So above all these national level banks, it's the European Investment Bank, or EIB. The EIB directly finances projects, corporates, or financial intermediaries. These are typically above 10-20 million euros in total cost, depending on type and scope. So for smaller municipalities, it operates through national development banks. That's about the InvestEU program. One very important thing that I wanted to mention here is the the EIB's Natural Capital Financing Facility, or the NCFF. So this is particularly relevant here. It is specifically designed for biodiversity and nature-based solution projects, offering blended loans and technical assistance. So if you have a nature project, let's say of meaningful scale, probably or maybe the NCFF is worth investigating directly. The practical advice is that you should not maybe wait until you have a fully developed project to contact these institutions. You could start a relationship early. You could, again, reconnect if you haven't done already your National Development Bank's website, find the green or sustainable finance section, and maybe book a conversation if you think that could be relevant. Many of these development banks offer pre-financing advisory services and can help you structure a project before it becomes a formal lending application. Technical assistance is often available before lending, and it is one of the most valuable resources that a municipality can access. So just to give a recap, basically, or practical overview of the EU financial instruments that could be relevant for nature finance. Again, I would imagine that many of you could be familiar with these. Understanding what is available, though, and for what purpose is essential for building an effective funding strategy. The LIFE program, for example, is the EU's flagship instrument, specifically for environment, climate, and biodiversity. It funds a wide range of activities, habitat restoration, species recovery, and increasingly innovative finance mechanisms for nature. So LIFE can co-finance pilot projects that test new approaches to nature finance, including blended finance structures or PES schemes. For the partners in this program, LIFE is naturally a starting point for any project that has genuine innovation or demonstration dimension. InvestEU is EU's main investment program for the current budget period. Of course, it provides guarantees to the EIB and other implementing partners, enabling them to offer loans, equity, and guarantees to public and private project promoters at better terms, maybe, than the market. Within InvestEU, there is I think a sustainable infrastructure window, and social investment and skills window could be relevant for nature projects. There is the InvestEU Advisory Hub that provides technical assistance for project preparation. Then there is the European Local Energy Assistance, was originally designed for energy efficiency and renewable energy projects, but then it has been extended in recent years to cover sustainable urban mobility. So this LNS provides technical assistance grants to help authorities develop and prepare projects. Even though its primary focus has been renewable energy infrastructure, it could be relevant for projects where maybe there is like a nature element, let's say a biodiversity bolt-on for a solar project. Then there are, of course, the European Regional Development Fund and Cohesion Fund. The nature and biodiversity are eligible instruments under several of their thematic objectives, including climate change adaptation and environmental protection. Horizon Europe funds research and innovation, including the development of new nature-based solution approaches, potentially a nature finance mechanism. So the key point is that almost all of these EU instruments are designed to leverage and, of course, not to replace other finance, and they work best when they are combined with national funding, municipal co-financing, and private investment. Understanding the leverage role, though, is essential for designing effective financing structures. 2 slides on how EU regulation and quasi-regulation are affecting demand of investors for nature. So before we look at how investors might look at nature projects in general, this is not a place, of course, for detailed regulatory briefing, which would require a separate session, but it is essential that municipalities understand the direction of travel, because it directly affects which investors will look at nature projects and what they will require. So there was a full session on EU taxonomy for sustainable activities, so I won't delve into details, but just to mention that it covers 6 environmental objectives, including climate change mitigation, adaptation, and the protection and the restoration of biodiversity and ecosystems. For an activity to be taxonomy aligned, it must make a substantial contribution to at least one objective and do no significant harm to the other 5, and then meet minimum social safeguards. For nature project, taxonomy alignment is increasingly important because institutional investors are required or prefer to allocate capital to taxonomy aligned assets. The nature project that can demonstrate taxonomy alignment has a significantly broader pool of potential investors than one that cannot. The Sustainable Financial Disclosure Regulation, or SFDR, requires investment funds to disclose how they integrate sustainability risks into their investment process and what negative impacts their portfolios may have on the environment. This is creating pressure on fund managers to understand and manage their funds' exposure to nature-related risks and to demonstrate positive impacts in their portfolios. Then there is the Corporate Sustainability Reporting Directive, or CSRD, which requires large companies to report in detail on their environmental impacts, including their dependencies on nature and ecosystem services, and their impacts on biodiversity. As companies begin to map their nature-related risks and dependencies, many will discover that they rely on ecosystem services that are a risk, and some will seek to fund projects that protect or restore those services. For local governments, I guess the practical implication is that the regulatory tide is flowing in favor of nature finance, and this creates a window of opportunity. Projects that are well designed, clearly impact positive for nature, and verifiably aligned with EU sustainability standards will find an increasingly receptive investor audience over the coming years. Quasi-regulatory standards and frameworks do define what credible means in nature finance, so projects increasingly need to speak the language before investors, corporates, or development banks engage. So this would sit alongside hard law as a parallel layer, let's say, of standards disclosure frameworks. These are roadmaps or policies that may not be legally binding on day one, but are rapidly becoming market expectations. So a few things to mention here. Maybe I'll not mention everything because I see we're a little bit short on time, and there might be some terminology here that you might want to look up on your own. But let's say the emerging task force on nature-related financial disclosures. There is a framework that is voluntary but is being rapidly adopted for nature-related disclosure by companies and financial institutions who want to demonstrate nature-positive outcomes. Then there is the Science-Based Targets Network that translates that logic into corporate target setting for land, freshwater, and ocean systems, creating potential demand for even landscape scale projects that can help companies meet those targets. I mentioned the EU Nature Credits Roadmap before, and the biodiversity strategy, the Kunming-Montreal biodiversity framework that basically is a global ambition set on biodiversity with 23 different targets, including a target on mobilizing, I think, $200 billion USD per annum for biodiversity finance by 2030. So to mobilize private capital effectively, local governments need to understand how investors think. Of course, not in abstract terms, but in specific terms that determine whether they say yes or no to a particular investment. At the most basic level, every investor, I would say, evaluating 5 things, or at least I pulled out 5 things that they would look at for almost any project. So this section is, and this is the closing section, is in how do investors look at nature projects. So first would be return. How much money will I make as an investor? Return is usually expressed as an annual percentage. Let's say the internal rate of return or a yield. different investors have different return requirements depending on their mandate and their cost of capital. A commercial bank might need a return double or triple that of a concessional capital provider to justify a loan. An infrastructure fund, let's say, might accept a stable long-term asset, but could require something you call, let's say, illiquidity premium in investing in a real asset. An impact investor could also accept somewhat less return if the social and environmental returns are compelling. So understanding what return threshold applies to which investor type is essential for structuring a project correctly. Second is risk. How likely am I to lose my money or earn less than what is expected? We have already discussed the types of risk in nature projects. So from an investor's perspective, the key issue is not just the absolute level of risk, but whether the risk is identifiable, measurable, and manageable. An investor can accept quite a high risk level if they can model it. What they cannot accept is, of course, the uncertainty that cannot be quantified or managed or mitigated or maybe shifted to another stakeholder, for example, via insurance. So a third is liquidity. It's about, can I sell my investments if I need to? Liquidity does matter because investors are not always in a position to lock up capital indefinitely. So bonds, of course, can be traded on secondary markets, and shares in listed companies are liquid, but stakes in a special purpose vehicle holding a wetland restoration projects are illiquid. There is no established market, let's say, to sell them. Illiquidity does demand a premium, as I mentioned before, and then it can rule out certain type of investors who might have liquidity requirements, or it might limit their appetite. Fourth is the sponsor. Who is running this project, and can I trust them? As I mentioned, investors invest in people as much as in projects. So a municipality with a strong credit rating and a track record of delivering infrastructure projects is a much more credible sponsor, of course, than a newly formed NGO with no financial track record. Co-sponsoring, let's say with a multilateral development bank or a national development bank, a project or a solution can significantly improve credibility. Fifth is about the exit, as in how do I get my money back? All investors need a clear exit strategy, either through regular cash flows that pay back the principal over time, or through a terminal event like an asset sale or refinancing. Nature projects can benefit from having a clearly defined exit mechanism built into their structure if they were to accept private capital for their project. So the important insight, I guess, is that local governments, for local governments, is that the investor universe is of course not monolithic. Impact investors, infrastructure funds, development finance institutions, insurance companies, and land value investors all have different profiles and requirements and motivations. Matching the right type of investor to the right type of project can be a skill, and getting this match wrong can be a reason for why a nature finance transaction failed to close. I have left you here with a quick reference guide on what factors would normally equity or debt investors would look at. Of course, I wanted to really mention here that this list is really not fully exhaustive. It's just to provide sort of a high level view of categories of what some of these investors might be looking for when they are looking at an investment opportunity. So before we close the summary, I think this is my last slide, and just to underline what I mentioned about matching a capital and to the phase, or matching the phase or to the capital, is one of the main reasons why nature projects fail to mobilize investment. So the second point is that investor fit is not only about mandate, it is also about timing. The different kinds of capital come in at different moments in life for a project or a solution, and it can be a mistake to approaching sort of investors that only want to invest in mature projects too early. At pre-feasibility stage, most projects are still concepts. They need studies, they need baseline, they land and governance clarification, they need often project design support. This is why right capital could be here as usually technical assistance, grant, philanthropic capital, or NGO-led development and support, and not commercial debt. The feasibility and structuring stage, the project, this is where the projects maybe start to become viable or investable. This is where advisory platforms and local development finance institutions, public or blended finance actors become important because they can support financial modeling, legal work, taxonomy, and do no significant harm alignment, for example, MRV design or other preparation costs that commercial investors would rarely fund upfront. I'd say at first investment stage, the project may still be too risky for mainstream capital, but it is developed enough for blended structures. This is where concessional lenders, guarantees, first loss capital, public co-financing, and impact-oriented investors often play the lead role. They can help bridge the gap between, let's say, public good logic and investor-grade structure. And then typically only when projects are tried and tested and replicated and the risks are clearer, do commercial banks and institutional investors tend to come in at scale. At that point, the solution might be suitable for even senior debt or loans with relatively well-tailored risk-adjusted returns that I mentioned before, refinancing or pooled municipal bonds, infrastructure debt, or other institutional real asset solutions. So sequencing matters. I guess a local government maybe should not ask, how do we attract institutional capital tomorrow, but maybe what stage is our project at and what kind of capital fits that stage, and what do we need to build so that the next stage of capital can enter. This is how a solution can move from a grant-supported preparation to, let's say, blended finance, and eventually, in some cases, maybe to mainstream investments. So I have a quick summary slide just to recap today's session. So before questions, so we covered the full conceptual framework. First, there is structural investment gap in nature in Europe. The scale of what needs to be done for biodiversity restoration and climate resilience cannot be financed by public budgets alone. Private capital must be part of the solution, and local and regional governments are central actors in making this happen. Second is that private capital faces 4 structural barriers when it comes to nature projects. The public good problem means there are no obvious revenue streams. The risk and time horizon means that the return profile is unattractive to mainstream investors. The pipeline problem means projects are too small and not investment ready. And missing policy frameworks mean that there is insufficient policy certainty to support long-term investment commitments. Third, bankability is a core concept. So bankable project has a credible revenue stream, a manageable risk profile, a competent sponsor, and a clear legal structure. Fourth, EU regulation is creating a structured tailwind, of course, for nature finance and sustainable finance broadly. The EU taxonomy, the CSRD, the SFDR, related frameworks generating growing investor demand for credible, verifiable, nature-positive investments. Fifth, it is important to understand what is the mandate, the risk appetite, the scope of assets of potential investors, and what type of capital instruments and providers are best engaged at what stage of different solutions, and what are the most important aspects of project evaluation by investors, not forgetting common structure failures that prevent a project to achieve a financial close. So before I close, so tomorrow in session 2, I would move from concepts more to a bit pragmatic action, so specific tools that municipalities have in their hands, and then maybe a few case studies that show what has worked in Europe and maybe beyond Europe as well, which I'm a little bit more exposed to, and the direct translation of that into maybe an actionable roadmap. So thank you for your attention, and I will hand back if there are any questions. This is a very broad topic, so I will try to attempt to answer if there is any. I'll hand back to you, Anthony.
Yes, indeed. Many thanks, Matyas, for the information and the presentation. So this is the time for questions and answers. So please, if you have questions, write in chat or in the Q&A chat or just in the chat so we can read your questions. So we have a question here from Jana, and I will read this to you, Matyas. Don't you think that 20 billion euro gap per year is impossible to cover in the whole European Union, especially as the need for defense funding is so huge? It's the first question.
Yeah, especially for, sorry, I didn't hear the...
Yeah, especially as the need for defense funding is so huge.
Yeah, so of course I don't want to be fully idealistic here, and it is one of the, I guess, important question of our time, which is that not just defense and also energy security, if I understand the question well, has been drawing some attention for the last couple of years from sustainability, and I think this is something that I probably experienced firsthand in my work, and how people talk about sustainability and nature. I think I will not be able to tell you whether it's a yes or no answer, but it definitely is much harder to, or has become harder in the past few years to make people, investors interested more in sustainable solutions. But on the other hand, I think that probably the EU, Europe, but more narrowly, the EU is a great, I think, island in the globe in terms of attempting to provide the mechanism and the regulatory framework, notwithstanding to some delays. So I sort of on your side as well, but of course, so I do agree it's going to be hard. I wouldn't use the term impossible though, so that's something that I would not use. I'm a bit more optimistic than that.
Nice. So we have a second question from Marco. To what extent do national differences in environmental regulation, permitting, and ecosystem valuation continue to fragment the EU market for nature investment, despite common reporting standards like CSRD and ESRS? He mentions differences between countries. Maybe it is easier in one country to do some projects, while in other it is more difficult. So how do these differences affect investor confidence and the scalability of nature-based finance across EU?
Sorry, because I might have missed the first part, but yeah, so basically the question is about the fragmentation of regulations and different frameworks that do exist globally, but also potentially in Europe. So how does this affect scalability of nature investments, right?
Yes, indeed.
Yeah, it is a challenge. I got to think about this. I think though, so the will is definitely there in many cases. This fragmentation is not very helpful, but if, let's say, there is a larger market and the EU is a very large market, there at least there could be some sort of standardization of frameworks that could be helpful, at least at a regional scale. Globally, how much does that help? Again, it depends on the size of the market. So obviously, the EU is quite large and it has a quite huge environmental impact. But then you could argue that the other parts of the world have much larger impact. So it's a very tough nut to crack. Yeah, so the sort of global frameworks, I think the positive here that I could say how the different global frameworks that, for example, it used to be the TCFD, the Task Force on Climate-Related Financial Disclosures, to what extent it did affect later regulations that were implemented for different countries, that I think it's a positive story. And I think it could be the same for nature, hopefully, in a not too distant future, so that, you know, the different frameworks are somewhat more harmonized. And then we get to the problem of how to harmonize, let's say, the different carbon compliance markets and mechanisms and the carbon credit markets in different parts of the world. So it is tough, especially because of what I mentioned in my first response.
Amazing. So I believe it is fine. So I believe it is good time if we don't have any additional questions from the audience to close the session. So Helena, please, you can go.
Yes, I have a question in the Q&A. I put it in the chat.
Okay, many thanks. So I will read it. What mobilization rates are generally achievable in development projects? If you could share some industry benchmarks, please.
Yeah, I will look into this a little bit more for tomorrow, but I think I mentioned some typical mobilization rates when I was talking to one of the slides, but I don't want to say a number that is fully incorrect. But yes, at a high level, I think nowadays, for what I've seen, it would be between, let's say, 1 to 5, maybe 1 to 7, or maybe less. I would need to revisit the World Bank has very good publications on this, maybe others as well. But if you, let's say, were to aggregate projects, and I've worked in some of these, or I've seen some of these examples, and multilateral development banks have very good pilot projects on this, to how to create collateralized loan obligations, where they pool a lot of projects into one specific vehicle, and then they issue bonds or notes, the specific debt instruments in the back of that. In those kind of structures, if the risk is allocated correctly, this multiplication ratio can be much higher.
Nice. So we have a short question then from Helena. What are the low-hanging fruits for NATUREFIN partners to improve the regional policy instruments to make the regions attractive for sustainable finance projects?
What are the low-hanging fruits? I think hopefully the session tomorrow would talk to those, because that's where I have some basically a toolbox, and I will specifically look into this if the low-hanging fruits are explicitly called out. But yeah, hopefully my session tomorrow will answer that question.
Perfect. So many thanks for your questions today. So the session is going to close. So many thanks. We will see you tomorrow. And remember that URL, the link is valid for the 2 days. So you will use the same link, you will enter, and then you can come to the session. It's the same time, 10 to 12. So please come at them, and we will start the day 2 with Matyas tomorrow. Many thanks for your time. See you all. Have a nice day.
Thank you.